It's Friday, 19th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, counting the economic cost of rising crime in Latin America. But first, Group Chief Economist Neil Shearing joins me down the line from Copenhagen, where he's just been meeting clients, and he's going to put another week in global macro and markets under the spotlight. Hi there, Neil. How's it going?
Hi, David. All well. How are you?
Good. I'm bracing for this planned phone call between Donald Trump and Xi Jinping. That's meant to be happening later today. I'm told it's about 2 o'clock London time. That's 9 o'clock in Beijing. The call's happening at the same time. There's reports of planning in place for a Trump-Xi face-to-face meeting, their first face-to-face meeting of the second Trump administration, to happen later in the autumn. It does feel like there is a push on both sides to de-escalate, to get a trade deal done, to stabilize relations, to stabilize the bilateral. Do you think we're going to come away from this with both sides having learned to live with each other?
We've always said, haven't we, that despite the book that I've written, The Fractured Age, this US-China superpower rivalry, two countries pulling apart, none of that has precluded, in my mind, and indeed we've discussed before, the idea of some kind of deal that will be done between Trump and Xi over the coming years. I've always thought that the idea of kind of a signing ceremony in the Great Hall of the People and the Rose Garden in Washington was something that would appeal to both, frankly, Xi and to Trump. So I think that's the direction in which we're heading. The question, I think, is what will it amount to? And I think the answer is probably not a great deal. I mean, just narrowly on trade, if you look back to the phase one deal that was done in Trump's first administration, China committed as part of that deal to import about $250 billion worth of goods from the US in the first year, and then $300 billion in the second year, there or thereabouts. Actually, what it ended up doing was it's never really got above $200 billion. So it's fallen well short of those 250, 300 billion targets per year in terms of goods imports from the US. So China never met its phase one commitments in terms of goods imports. So I think we should be skeptical of any deal that includes promises to buy US soy or whatever it might be, that those targets will be met. And I think more generally, the idea that there will be a deal that is done that addresses the fundamental sources of tension between the two superpowers, I'm also skeptical of. So if you think about what would be needed for a kind of lasting reset in relations between the US and China, you would need tariffs to be really substantially rolled back by the US. Well, that's unlikely to happen given the US now requires the federal government in the US requires the revenue to help fund the deficit. You would need agreement on tech and tech transfers. Arguably the most important news this week was not this phone call between Trump and Xi, but the instruction by the Chinese government to domestic firms not to use NVIDIA chips, advanced NVIDIA chips, and to use domestic chips instead, because it wants to develop self-sufficiency in these areas. So you get the sense that China's becoming a bit more assertive. It knows where the red lines are in this relationship. Long story short, I think that clearly a deal is going to be done. Clearly, there will be lots of headlines that surround that deal about a reset in relations. I'm skeptical that the trade element of that will really amount to a great deal in practice. I'm even more skeptical that it's going to lead to a more fundamental reset in relations between Beijing and Washington.
So if we don't get this reset, then just remind us, because we have the global economy has this overhang, if you like, of this deterioration in the US-China relationship. If a deal isn't enough to fundamentally change that, then what is the direction of travel?
Well, I think it's towards ever greater fragmentation between the US and China. But the key question in my mind is not necessarily can that be arrested? Can that be stopped or reversed? Because for the reasons I've just discussed, I don't think that's likely. So the idea that we just reverse it, stop the train we want to get off, I don't think is the right response. The question is, where will the fault lines of this fracturing be drawn? Can it be drawn in a way that it minimizes the economic costs on both sides? And also, how do other countries align in this fractured world? And that's a kind of critical issue, particularly India now, having lent towards the US in this fractured world, and now its place in the fractured world coming into question, might it move a bit closer to China? So to my mind, the questions we need to be asking is not, can there be a lasting rapprochement between the US and China, but rather, can some kind of deal kind of slow the fracturing between the US and China? Can it contain it to areas that are deemed to be kind of strategically important from a national security perspective, and therefore stop it bleeding into wider areas of trade and finance? And then from the US side, can it keep its bloc together? Because its bloc is economically larger, it's more economically diverse, it starts from a position of strength as a result. But if it starts to irritate its allies with its seemingly kind of arbitrary trade policy and foreign policy and pushes them into China's arms, then it will essentially shoot itself in the foot.
Just go back very quickly to that NVIDIA report, because it was very striking, wasn't it? The US has been trying to restrict sales of these chips, of NVIDIA chips, the hardware powering this AI technological revolution. The controls started under Trump, but they continued through Biden. That's telling, isn't it? But now in Trump's second term, we've seen shifts in policy. There was a push within the White House to relax restrictions just a few weeks ago. And then the Chinese have been pushing back and instructing its firms actually not to buy them, even if the US is going to allow the sales to happen. Guidance to Chinese firms is don't buy these chips. You did talk there a bit about this idea of a self-sufficiency drive in China, but what is the big picture? What are the key messages from these reports?
So the first point we should say is that at this stage, this is just a report in the Financial Times. It's not been confirmed, but maybe even that's significant, right? Because the fact this is quite guidance being given to Chinese firms rather than a public statement, it comes at a time when clearly China's trying to soothe ties with the US, so it doesn't want to necessarily rock the boat ahead of this call. Now, I think the immediate consequences for China's economy of banning the import of NVIDIA chips is going to be relatively limited. Instead, the significance, I think, is that it signals a kind of strong commitment by the leadership over the long term to developing cutting-edge chip capabilities domestically. So the context here, of course, is the back and forth in Washington about, can NVIDIA sell certain chips to China, or is it subject to bans? Then Washington relaxes some of the controls. And actually, rather than China saying, great, we'll gobble up some of these chips, thanks very much, it said, no, we don't want the chips. We want to develop a domestic source of these chips because we see it as an area of strategic importance going forward, and a source of vulnerability if we're reliant on US chips in the future for AI models, et cetera, et cetera, et cetera. So it's another reminder of the geopolitical fracturing that we're seeing in the global economy. It's emanating as much from Beijing as it is from Washington. We tend to view all of this through the lens of the US and Trump, but actually some of this is coming from Beijing too.
So is China's chip industry then going to head the way of electric vehicles and solar panels and pretty much everything it produces, where every local government worth its salt suddenly piling funds into the industry and factories are churning these things out, and before you know it, markets flooded and we're in this state of overcapacity?
China is funneling vast resources into developing domestic sources of semiconductor production. So if you look at China's share of semiconductor production that's produced domestically, it's increased from about a quarter in 2017 to close to 40% today. So the share of China's semiconductor consumption produced domestically is increasing. However, it consumes a vast amount of semiconductors, China does. The value of its semiconductor imports is higher than the value of its oil imports. I think it's less that China is going to turn into this large net exporter of semiconductors in the same way that it has done with electric vehicles, for example, and more that the import component is going to shrink and the domestically produced component will grow. But you do touch upon a kind of important question, and one that's actually come up frequently in client meetings this week, which is that this issue of Chinese overcapacity in certain industrial sectors, how that plays out. And we're seeing it in electric vehicles, we're seeing it in other parts of the manufactured space. With the US now pushing back against imports from China, where are those imports going and how will those countries respond? And that's a really interesting question. If you look at China's trade surplus now, China runs a larger trade surplus with emerging economies than it does with developed markets, which I don't think is necessarily leaked into our kind of collective consciousness yet. And I think if you look at India, if you look at Brazil, frankly, the EU as well in the developed world, I think we're going to see increasing pushback against Chinese exports over the coming years. I don't think it's necessarily something that's going to happen immediately, but we'll start to see that building, I think, over the next 2 or 3 years, because these countries share to some extent the security concerns that the US has, but they all share the economic concerns that they don't want their manufacturing base undermined by Chinese competition.
Neil Shearing there on US-China fracturing, chip wars and the overcapacity threat. He mentioned his book, The Fractured Age. Find it now in all good bookshops. We're not contractually obliged to plug it. It really is worth a read to understand how this breakdown in US-China relations is changing the global economy. Neil and Mark Williams, our chief Asia economist, were briefing clients in London this past week about fracturing, and this series of global events moves to New York next. I will add details of our October 9th fracturing event there to the podcast notes. I'll also add our analysis about that NVIDIA report to the notes as well. Neil and I didn't have time to get into this past week's Fed and Bank of England meetings, so here's a clip from our client drop-in, these are our short-form online briefings, that was held just after the Bank of England meeting on Thursday to cover off the recent big central bank decisions. In this extract, you will hear Jennifer McCune, our chief global economist, talk to Deputy Chief North America economist Stephen Brown and Chief UK economist Paul Dales about what the Fed and Bank of England just decided. And it begins with Stephen talking about that Fed rate cut, about how the latest projections from the FOMC now see an additional rate cut before the end of this year, and how that corresponds with our expectations.
I would say, though, in terms of our own forecast, we've been expecting just one additional cut this year. You know, we're still thinking about that a bit, but I don't think we're minded to change it really. So although the median projection is for 2 cuts, it's quite a close call. It would only take a couple of members to change their minds and shift back to just being one more cut this year. And given that we're quite upbeat on economic prospects and expect the unemployment rate to stabilise, I think we're quite comfortable with our view for the time being.
Okay, thanks. We have several questions about that. One of them is obviously this shift back into cutting mode seems to have been driven by the weakness of the labour market. But the other side of the coin is that we're not really seeing any significant inflationary impulse from tariffs, which perhaps we'd feared earlier in the year. Why is that not happening? And do you still expect it to come?
Yeah, I would say it's definitely a bit of a shifting narrative underneath the surface, really. We haven't seen as much of an impact on goods prices, certainly. So to put some figures on it, we sort of suggested that the tariffs could boost CPI by between 1 and 1.5%. And overall, we've probably seen no more than kind of 0.3 or 0.4 percentage points at the moment in terms of the impact. So it's been feeding through a lot more slowly than we expected. So we initially based our forecast on the experience during Trump's first term when the set of tariffs were a lot narrower. This time they are feeding through for various reasons, including, for example, automakers in particular, I think, waiting for a bit more certainty to see what would happen. So only in August did we see new vehicle prices begin to edge up. Even if we do still get the same impact we expected, because it's being spread over a slower period, that's one reason why the Fed doesn't have, a longer period, that's one reason why the Fed doesn't need to be concerned, because the way it thinks about this is a sudden big rise in prices would have pushed up inflation expectations, risk putting upward pressure on wages and risk higher inflation being sustained. Whereas if it's kind of just a slightly larger than normal goods price effect for, say, 12 to 24 months, that's not as concerning. I say it's a shifting narrative, though, because the economy is certainly doing better than I think many expected. And indeed, the Fed's projections, it was quite unusual that the Fed even shifted towards more rate cuts in its forecasts, albeit only one more, because it actually revised up its forecast for GDP growth. And despite the recent weakness in the labour market, expects the unemployment rate to now be lower by the end of next year than it did before. So it's kind of quite upbeat about the outlook, and that's in part driven by the strength of the recent economic data outside of the labour market. So I think in those terms, there's stuff coming through in terms of services prices that we didn't necessarily anticipate. So although we haven't got that goods price inflation, we've got maybe a bit more concern that there could be more genuine services price inflation as a result of stronger economic growth. So even though we don't necessarily have these tariff effects, there's still these inflation effects that the Fed will need to guard against. And again, coming back to our own forecast, that's the reason why we think the Fed probably won't follow through with all 3 of those cuts this year.
I'm going to come on to the UK now and to you, Paul. We've had various good questions coming in. Just to start with, The decision today to leave rates on hold was maybe even less surprising than the Fed's decision to cut. But what did you take from the bank's communications, Paul? Is there a direct contrast with the Fed here in that high inflation it might be overtaking weak activity as the Bank of England's main concern?
Absolutely, yes. So interestingly, when I look at the labour markets in the UK and the US, I think the UK market looks looser than it does in the US. But the Bank of England has been sending, I think, a signal that it's less inclined to cut interest rates, just at the time that the Fed is sending signals it's more inclined to cut interest rates. And the difference is the actual inflation figures and the outlook for inflation. So inflation in the UK is already 3.8% compared to 2.9% in the US. And it's going to go a bit higher in the UK as well, probably tipping above 4% in September. So given that backdrop, it's understandable, I think, that the Bank of England is more worried about inflation than the Fed is. And on our view, that means it probably won't cut interest rates at the next meeting in November or the meeting after that in December, and that it will want to see inflation start to come back down again before cutting interest rates again. We reckon the path will be a bit clearer by February. And then that loosening in the labour market I mentioned should enable inflation to come down a bit faster than most people expect. And that's why we still think interest rates could get all the way down to 3% rather than the 3.5% priced into the market.
That was Paul Dales and Stephen Brown talking to Jenny McCune about the latest Bank of England and Fed decisions. The briefing took in much more besides, including the impact of AI on the US economy and Fed thinking by extension, about the Bank of England's quantitative easing program and gilt yields, and what we think could prompt the ECB to come off the sidelines and cut rates. I will add a link to the full drop-in recording to the podcast notes. We run several of these short-form briefings each week. Just in the coming week, we have drop-ins about Brazil's economy on Tuesday, and then later in the week about big policy moments in China, India, and Indonesia. Check out our events page for the full schedule and to watch previous recordings. Now, crime rates have been rising in Latin American countries that had previously been considered fairly safe. Public safety is likely to overshadow key elections that are happening across the region over the next 12 months. As part of a series of work by our emerging markets team ahead of these elections, Chief EM economist William Jackson's been looking at what's been driving up crime rates in LatAm, their economic implications, and the consequences for the political outlook. I spoke to him early in the week, and I started by asking how crime trends in Latin America have been changing.
Crime seems to be an incredibly pressing issue across the region. It's always been a big issue, but it seems to become far more prominent after the pandemic. It's quite interesting why that's happened. Actually, if you look at the aggregate numbers, most say that crime rates are lower than perhaps a decade ago. But there have been a few important trends, one of which is that some countries that have historically been seen as quite low crimes, safe havens within the region, countries like Uruguay, Chile, Costa Rica, often termed the Switzerlands of Latin America, have seen a sharp rise in crime rates. Some of that's been pinned on shifts in flows in international drug trafficking. But I think maybe the more important thing is that for whatever reason, public perceptions of crime are rising, public anxiety is rising. And often when we think about the economic impacts of this, it's as much to do with people's behavior and their efforts to try and prevent crime as it is to do with the actual crime itself.
Your report makes the point that Ecuador has gone from the lowest crime rates in the region to the highest, and El Salvador from the highest to the lowest. And there's obviously a lot to unpack there. But before we do, talk a bit about, obviously there's an enormous social impact. You touched on that in terms of public perceptions of crime and the anxieties that causes. At the end of the day, you're an economist. We're a macroeconomics research provider. Talk about the economic costs to LatAm of crime.
You've got all the usual caveats. There's lots of uncertainty in this. It doesn't translate easily into the macroeconomic indicators we usually look at, but we tried to make some estimates. You can think about the impact on an economy's labor supply, for example, so because of incarceration, harm through crime, or emigration. Crime's a big driver of emigration from the region. And you can also think about the way both the public and the private sector spend money trying to prevent crime through extra security, through police forces, and so on. And that's essentially money that's being spent on trying to prevent crime that isn't raising productivity. It could be used for other more productive ventures. So we've tried to make some estimates. We came up with numbers that suggest that crime maybe plausibly knocks about 0.25 percentage points off GDP growth in the region. The IMF itself has provided estimates too. They come up with a slightly higher number at about 0.5%. And if we put this in the context of a region that has grown at an average of just above 1% a year for a decade, that's quite a big economic impact.
I mentioned Bukele. I mean, it's quite a striking case in terms of approaches to crime in Latin America and indeed globally. But talk a bit about what's happened in El Salvador under Bukele and what that says about broader regional trends.
The El Salvador example is pretty remarkable, and it's really important also for thinking about the lessons that people are drawing for the rest of the region. The sheer numbers are staggering. That if you go back to the 2010s, El Salvador had one of the highest murder rates in the world. In the last few years, it's had a murder rate more similar to Canada, among the lowest in the Americas. It's been a dramatic decline in the crime rates and the perceptions of crime. It's been extremely popular with the people of El Salvador. The president has sky-high approval ratings. So this was done through a very harsh crackdown on gangs. Something like 2 to 3% of the adult male population is now in prison. But it has provided some economic benefits. We see stronger GDP growth compared with pre-pandemic years. One area that's been particularly affected in El Salvador is tourism. Tourist numbers are about twice as high as they were before the crackdown. That makes a lot of sense. Tourists are going to be wary of going to countries with high crime rates. They don't want to be victims of crime. It's quite easy to choose to go to a lower crime country. I think the El Salvador example has also given politicians across the rest of Latin America the idea that crime can be tackled quite effectively and in a short space of time. El Salvador did this by cracking down on criminals. Politicians elsewhere in the region, they see this public anxiety about high crime rates. They see the El Salvador example and are quite keen to emulate it.
It's striking. It's a stat worth repeating. I think you said 2 to 3% of the adult male population of El Salvador has been incarcerated as a result of this crackdown. An enormously controversial policy, but clear economic benefits. You talked about increasing tourism to El Salvador. Your report contrasts that with falling tourism to Ecuador. We've got this packed electoral calendar coming up in the region. How is this all going to play out? How does this affect the thinking of candidates going into these elections, how they appeal to the public when you have this extraordinarily hot button issue like crime?
It's, I think, going to be a key dividing line going into elections. I think from the sort of investor perspective, a lot of attention at the moment is focusing on the possible shift from the left to the right in terms of economic policy making, moving perhaps towards tighter fiscal policy, more market-friendly policies. But I think the right wing of the spectrum also seems more inclined to adopt a tough on crime approach. It's incredibly hard to say what those approaches will amount to. But I do think there is perhaps a risk of reading too overly simplistic conclusions from the El Salvador example. This crackdowns on crime in the initial phase is very costly, strained public finances across the region. And the nature of crime is extremely complex and varies widely across the region. And while El Salvador's had a lot of success, there are other countries that have tried various approaches and have failed. Honduras a few years ago attempted to emulate the El Salvador approach. It hasn't really worked. In Mexico, there have been various attempts to crack down or to deal with the problems from the cartels, ranging from the war on drugs to the former president's hugs not bullets approach, neither of which have worked. So it's an extremely complex issue to solve, and I think there's no guarantee of success.
Is that it? It depends on where you are in the drug supply chain regionally is an indicator of the ease or otherwise in cracking down on crime?
I think that's one issue. The location of the drug supply chain definitely matters. A lot of the evaluations of what happened in El Salvador focus on the fact that the nature of criminal organizations there was quite different to in many other parts of the region. It was typically gangs fighting over extortion, or territory to be able to extort. They have relatively small income in the sort of tens of millions of dollars. That meant there weren't criminal organizations that could come up in their place. I think it's perhaps a very different situation if there's a very lucrative narcotics trade with revenues in the billions of dollars. If there's crackdown on one organization, others may simply come into their place. It may be much harder to crack down on those.
And talk about the rightward shift that you suggesting may happen as the outcome of all of these elections. How far right are we talking? Because in the case of El Salvador, there has been evidence, hasn't there, of institutional erosion, democratic backsliding, you call in your report. Is that a risk across the region? I mean, looking at it purely from a macroeconomic market return perspective, is that a risk that investors should be watching?
We're at a stage where there's still a degree of uncertainty about the runners and riders in elections. That have great opinion polling at this stage. We do see some quite far right candidates being mentioned. But I think this will certainly raise hopes of a sort of shift from the left-wing governments that are currently in place that have raised concerns about loose fiscal positions, debt problems, in some places attempts to interfere with central banks to get them to lower interest rates when it's not warranted. But there's certainly a risk, particularly with a sort of harsh crackdowns on crime, that you could see a broader institutional erosion. In El Salvador's case, there have been a lot of suggestions that the due process and the judicial system's being undermined. But one important factor too is the extent to which any president faces checks and balances from the opposition. In El Salvador's case, President Bukele's had very high support. He's been able to use that to perhaps sort of push for a more autocratic form of governing. It may not be possible if you take the case of Brazil, for example, where Congress is highly fragmented and always has been. It will always be much harder to govern in that style.
We haven't mentioned yet the elephant in the room in the shape of Donald Trump and Marco Rubio. Talk about how US policy is affecting this narrative. And maybe one way of doing that is drawing this contrast between El Salvador and what's happened with Colombia.
So there's a lot more focus on Latin America by the Trump administration. It has definitely shifted to looking south. There are a number of ways that this is playing out. Part of it is through this sort of competition with China for influence in the region. We've seen this with discussions about the Panama Canal. But drugs and crime are another avenue through which is happening. We've seen various cartels be deemed to be foreign terrorist organizations by the Trump administration. That came across as quite an important symbolic step. Mexico is facing US tariffs on non-USMCA compliant goods, purportedly for not doing enough to curb fentanyl trafficking. And most recently, we've seen Colombia be decertified by the US for its anti-narcotics efforts, although the US hasn't gone as far as cutting some of the aid that it could have done due to that decertification. And it does look like approaches to tackling crime, tackling drug trafficking could be a dividing line in determining how countries' relations with the US develop. We've seen really quite strong relations between the Bukele administration and the Trump administration develop, partly as a result of crackdown on crime. It's a reception of deported migrants from the US too. Whereas Colombia's much softer approach has clearly fallen foul of the Trump administration, although probably worth noting that the Biden administration before that was also losing patience with Colombia too. But it appears that a soft approach towards tackling drug trafficking is going to fare quite badly with the Trump administration. And it's potentially, well, we haven't seen this in Colombia's case yet. This is definitely an avenue through which tensions with the US could flare up with macro implications. It really wouldn't surprise me if we do see tensions between President Petro and President Trump flare up again, and anti-narcotics efforts are used as a premise for imposing tariffs on Colombia.
So put all of this together, you just mentioned tariffs. The region hasn't been spared tariffs from the Trump administration, least of all Brazil. At the same time, there is this potential for attempts to crack down on crime in the region. Putting it all in the mix, how does this affect the economic outlook for these countries? Is a potential crackdown on crime, is that an upside risk? Are the full effect of tariffs not feeding through? Is that a downside risk? So what does the picture look like for the next couple of years?
There are lots of forces that are going to be affecting the macro outlook over the next year. Tariffs are important for Mexico, but they're far from the only thing affecting the outlook. You have weakness in China weighing on commodity prices. That's an absolutely key one. We've got fiscal problems at home, the need for fiscal austerity. We've got high interest rates and still high inflation across the region. Generally, as we see it, this is it's not a disastrous outlook. We expect economies across the region to be growing, but at pretty mediocre rates, sort of around 2% for many economies, a bit less for Mexico and Brazil. Possibly successful crackdowns on crime could be an upside risk, but I think it's probably optimistic to expect the El Salvador experience to be replicated en masse and to have the same effect as in El Salvador and bringing crime down.
That was William Jackson on crime in Latin America and the economic outlook. I will add his report and our latest LatAm outlook to the podcast notes. Don't forget our Brazil drop-in this coming week, and look out for more coverage of these elections in the coming weeks and months. But that's it for this week. Neil and the rest of the team will be back next week to tackle more of the big issues in macro and markets. Until then, goodbye.